Welcome back, everybody. This is your Valentine's week edition of We Talk Money. It's good to be back with you guys. We were in Colorado over the past week getting in some skiing, and now we're back ready to crush the markets.
Didn't break anything. That's a win.
That's the most important thing.
We all made it.
We all made it. A little bit under the weather, but I think we're gonna be able to get through this all right. So anyway, guys, actually quite a lot to cover this week. Still have a lot of craziness with coronavirus, Bitcoin breaking out, markets making new all-time highs in stocks over and over and over again. Even in the face of all this fear and uncertainty and doubt in the markets. What do you guys make of that?
I mean, it's quite euphoric considering that coronavirus is likely going to have a large impact on the economy, right? I mean,
well, and like we talked about last week, we looked at the market gains, 6 months after all the past pandemics, and for the most part, the markets always recover. Mm-hmm. Why could this time be different, or is this time going to be different?
It's a great question. I think one of the things that's different about this one is, the market's in a different position as this is hitting, right? So, it is at all-time highs on the U.S. indices, and there is a lot of euphoria. Valuations are pretty high relative to history. So, you've got that backdrop of an environment, and then all of a sudden you have something like this that can hit. And I think investors may be shaking this off a little bit too much. I do think obviously in the long term it may not be an issue, but for the next 6 months, China's the second largest economy in the world. It produces a lot of key things in the supply chain for very important companies, from Apple to car manufacturers to retailers, etc. Yeah. So I think supply chains could get pretty wrecked over the next couple of months, at least in the short term. And then there's so with the high valuations, and then people just sort of not factoring in that this could be another year of no earnings growth in the S&P 500, then it starts to look like after 2019, which was a year of no earnings growth, at least across the S&P 500 on average, then people start to look at that and say, oh, manufacturing sector's down, S&P 500 earnings not growing. Maybe we should actually revalue stocks at a lower valuation level. Mm-hmm. So I just think the combination of those things, with the valuations being too high and then potential risk to earnings growth this year again, I just see a disconnect there. One other thing that we should know too is that the commodities markets are suggesting something different, right? Equities markets are hitting all-time highs, but crude oil and copper particularly are showing very, very very, very weak performance here going into February. I think crude's down about 20% year to date now. Yeah,
kind of peaked off or peaked out right at the start of the year around $65, and we're down to right around 50 today.
Yeah. And copper was down something like 14 days in a row.
Yeah, that was pretty insane.
Yeah, it's starting to stabilize a little bit here, but yeah, I mean these are industrial-based commodities that are used as inputs in a lot of different actual physical products and manufacturing. So this suggests that the buyers of these commodities are seeing much lower need for these things in the near term. So.
What is it, 50 or 100 million Chinese citizens are now basically under quarantine or lockdown, and that's essentially just brought most of that economy to a halt. So that is definitely going to have some kind of fallout. It's just how big is that fallout going to be? Yeah. Even if they can cap the virus, I mean, it's going to have kind of a domino effect, and that was my concern, is this could actually cause kind of systemic, one thing falls after the other, and then before you know it, we're in a full-blown recession.
And that's exactly how recessions start. It's the domino effect, and it takes a certain portion of the economy to really pull back, and then that causes that cascade for other businesses and then eventually other consumers.
Yeah.
But for some reason, the market's not seeing that. At least that's, the
market ain't scared.
Market. The market's not scared right now.
Yeah. New all-time high on the S&P today.
We had a little shakeout, not much of a correction, really, on a percentage basis, and here we are. So.
Yep.
And
something's.
We are seeing, a lot of companies right now. We are in the midst of a Q4 reporting season, so companies are reporting their Q4 earnings, which would not really be affected by coronavirus yet. And those results, frankly, look pretty good for a lot of companies. And so the market's taking that news and I think over extrapolating that. So Yeah, we'll see what happens. I just think we're definitely in a riskier environment now than we were even a month or two ago, from my perspective as an investor.
Yeah, I agree. So I guess this is something that we should just keep our eye on really closely over the next few weeks.
It still
just
needs to unfold.
Yeah.
We need to see how it goes.
Well, Bitcoin obviously has not been affected by, at least the price has not been affected by the corona fears. We recently broke back up above 10K for the third major time in history. The first time was during the bubble of 2017. Second time was summer of last year. And then right now we're kind of just peaking up above it. And, we've got roughly about 3 months until the halving comes in. So this could be buying in anticipation of that. Also, with a lot of fears around the world with virus and recession stuff, Bitcoin is kind of viewed as maybe a flight to safety, or at least some kind of other asset that is not tied to earnings of companies. Pretty interesting. I'll just kind of recap my actual trade that I took. So I recently did a YouTube video kind of showing this, but we had a nice reversal pattern here in early January, had an inverse head and shoulders neckline break, bought as we got up above that 100 period moving average, and then actually hit the first target through the 10K zone. So I'm still holding a large piece of this position, and as long as the bull trend stays intact, I'm going to hold that. It'd be nice now that we are in bull market structure territory. It'd be nice to see another setup over the next few weeks, or at least prior to the halving, to have another buy opportunity there. So
the chart looks good.
Chart does look strong. Wouldn't be surprised to see if we get a pullback to shake out anybody buying above 10K. Yeah. But we'll just keep our eye on that. And then obviously kind of the hero here in the altcoin space has been Tezos. This is one. Pull up Kraken. This is one that we got in pretty early. Crypto Hustle, aka Rocky, helped us get into this one in the mid 50-cent range. My cost basis is somewhere around 70 cents, and as of today, it's peaking up and testing the first profit target up here around $3. So, this trend is intact, and it's intact trade until it's not. So,
yeah,
beautiful.
What I like about this too is that it's one of these projects that has real fundamentals behind it, and that it could potentially be a platform for other developments in the crypto space going forward. The whole staking thing is cool too. It's sort of like owning something that earns interest. Lots of unique characteristics of Tezos. It's not just some flash in the pan shitcoin that doesn't have any developers working on it. Right?
Yeah. It's not something with a fun token. It's a real network. It's something that I know a lot of people in Silicon Valley are really excited about. As an investor, an institutional investor, people want to have control over a network, and Tezos gives that ability. So, so overall, just beautiful trade, nice growth, and I'll be keeping a very close eye on this one over the next few days and weeks.
Technical chartists must love this. I mean,
look
at that.
I mean, beautiful, just classic, classic accumulation range. Like I said, I mean, we were building into this. The ICO price, it was interesting. The ICO price, I think, was 30 cents. And then once it listed on Kraken, it listed higher, obviously dumped. Accumulation gave us another buy opportunity, scaled in through here, and up about 300% on it right now. So pretty awesome.
Very nice trade.
Yeah. One more thing I'll mention, I talked about this in my YouTube video, but I just wanted to mention this kind of quickly during this show because I thought it was pretty interesting that just under half of 1,300 people said that they check crypto prices over 10 times a day.
That's wild.
That's excessive.
And a lot of I was actually laughing at a lot of the comments here on Twitter and in YouTube. This guy... He has his Apple Watch set up with the price here.
Oh wow! That's
I was like, man, there's got to be some correlation between price of whatever market you have showing and your heart rate.
Yeah, that's pretty funny.
That'd be fun to look at.
But it just goes back to the idea of look, if you're obsessively checking prices, that means one of two things, or probably both. One, you either have a gambler's mentality, and or two, you don't really have a plan, right?
Exactly.
Like, and if you have a plan, you can set alerts. You can like box price, right? Where you're like, okay, if we break below this price or above this price, I want to know about it. Anything else inside of this range, I don't really care. Let me go about my day. If something happens, let me hear about it, right? And I think with a market like crypto that's 24/7, it's, you know, there is no market close, so it can be easy to be obsessive about it. Oh, and I was guilty about that in 2013. And you know, when the markets get moving, like I do focus in on it a little bit closer, but on an average day, there's no reason to be checking like 10, 20, 30 or more times a day.
Yeah, I really do. I like the idea of using alerts. I have the same issue sometimes with stocks, and what I had to figure out too is not only do I have some price alerts for certain stocks that I'm watching, but I also have news alerts. Because
how do you use news alerts? What do you use to track that?
So I use a couple things. I have the Centeo platform and also Seeking Alpha, and you can use free ones like Atom Finance, and there's some other ones like that will alert you for free as well. But the reason that I do that now is so that I don't check prices as much. That way, because one of the reasons I would check prices a lot is I would look for stocks that were moving, you know, above a certain percentage, and then I would go check on those to make sure there wasn't something I missed.
Gotcha.
But with setting alerts, then it's, you know, it's proactive rather than reactive, and so it's or reactive rather than proactive. I don't know.
Well, I guess exactly it's like there's like two ways to play the markets, right? There's anticipatory, and then there's like reactionary, right? Like anticipatory is you're like, okay, I think this thing is going to happen. I think this breakout's going to happen, or I think this earnings release is going to look this way. I'm anticipating and I'm taking action, anticipating it. Or I'm going to respond like if then scenario, like if this happens, then I respond in this way, right? So maybe that's what those news alerts can do, is help you understand when something pops.
Exactly right. Yeah.
I second Seeking Alpha for news alerts. I really like having the email alerts, and I found them helpful.
Yeah, they can be a little bit noisy sometimes. They'll they'll send you alerts for lots of different types of events.
You just have to like nix the articles, or else you're getting bombarded. But if you just want, you know, earnings reports and things like that,
exactly,
or like, you know, news, transcripts, things like that.
Yeah, there is a lot of noise, and I think it's important to try to like minimize the amount of data flow that's coming in, so you get the most signal with the least amount of noise. Yeah. For me, I use Feedly.
Yeah, I was just about to say another way is to set up like Google alerts, either through Google directly that send to your email, or through a service like Feedly, where you can set up alerts on keywords or companies. Or,
I really like that service. Cool. So talked a little bit about the markets. One thing we wanted to do today, guys, is focus a little more on Q&A. We've got the website live, so if you go to wetalkmoney.com and then just hit the button here at the top that says ask us a question. If you send us a question, we will do our best to answer it during the show here. So let's go ahead and jump over, and we'll take a look at some questions that came in. The first one we'll answer is from our Discord group from Skill Incubator. So OCY asks, for the next We Talk Money episode, I'd actually like to know the worst investment that you guys have made, and, you know, looking at it in hindsight going, what the fuck was I thinking?
I love this question so much.
Yeah. He said, personally, I've always learned a lot from the mistakes of others. I think that's so smart, and it's true. It's like if you can look at what somebody else has done, good or bad, and a lot of people just like to highlight their wins, right? But like if we highlight the losses and the mistakes that we've made, hopefully we can help other people save money. So.
I like to tell people that you should actually appreciate your losses more, because they teach you so much.
Yep.
Yeah.
Like without them, you can't get better and better and improve, right? So I don't know. I like to tell people to shift their mindset about that. And it's easy to get super upset, but take it, learn something from it, then you'll be better next time.
Okay, so let's start with you, Nikki. What is a loss that you've had that you think would be good to cover?
Iconics Group.
Iconics Group. Okay, let's take a look.
Iconics Group was a stock.
Was or is?
Technically it is.
It's hanging on by a thread, and they're probably going to have to do another reverse split.
Okay.
So they own a lot of brands that they license out. Retail brands, clothing brands, things like Umbro, which is a soccer brand that used to be super popular when we were kids, which was apparently supposed to be up and coming again. And then they owned a few other really popular brands that were in Walmart, Target, just big chains. Walmart kicked them out, didn't want their brand anymore, wanted to do their own brand. Target kicked them out, didn't want their brand anymore, wanted to do their own clothing brand.
Gotcha.
And Sears and JCPenney were some of the retailers that used their brands as well. Obviously, Sears is
no longer.
So
what happened with this one? You bought it and then...
So I bought this one, and I had already had some that I was holding for an investment.
Okay.
And then I saw this breakout opportunity on the chart.
What year was this?
It was 16?
2016? So somewhere maybe around
there. Yeah, and so I had bought it for a day trade.
Uh-huh.
I had already done some work on it, and I was already holding some. So at the end of the day, when I would normally close the position out, it hadn't gone, like it hadn't moved like I was anticipating. It was like hovering above the breakout level. So I was like, okay, and I just was like, you know what?
Let me just hold this.
I'm going to just hold this and turn it into a swing trade.
Yeah.
And that was the last time I've ever done that.
So wait, so you turned a day trade into a bag hold that lost like the whole position.
Yes.
Was it a big size
100%?
Like 100% loss.
I mean, it's
basically.
like it was like a 90% loss, but because the reason that I held it and kept holding it, because obviously you can cut your losses early. You don't have to take a 100% loss.
You bought somewhere over here, and then you held throughout all. I held through all of this.
At one point, I just ignored it and was like, well,
you just wrote it off as a complete loss.
I'm never gonna get my money back on this, but instead of selling it, I'm just gonna. Maybe they get bought out. Maybe they sell a few brands off and get some money to pay down debt. Maybe, Umbro does well in Target and, all of these things. And so
if anybody listening to this or watching this on YouTube has done that, where you took a trade and you took it either as a day trade or a swing trade, or maybe even it was an investment, but you knew like, hey, this hit my stop loss, or like I should cut out of this, and then you just for whatever reason couldn't, like just leave us a comment and say like I did that.
Raise your hand.
Yeah, raise your hand, because I do feel like that's something that's common and like not a lot of people want to admit to.
Yeah.
But that's something really good to point out that, okay, you did it once and you haven't done it in years since then. So,
and also this company had a lot of debt, and that's when I was really kind of working with Travis and, learning about fundamentals, putting fundamentals into my trading.
Yeah. Because you used to be purely chartist.
Purely a technical chartist. That was it. And at the time, I thought, you warned me about their debt. Travis warned me. He told me. He said, this is a lot of debt. And, I obviously didn't have the, I guess I just had hope for the, not hope, but I liked the brands that they had under their portfolio.
Yeah.
So I was like, I think this is going to make it,
And turnarounds with leverage, when they work, they can work big. I mean, Icon was a stock that was down already like 70 or 80% from like a year or two before you got into it.
And it was trading at a low PE.
Yeah.
Because that was the thing. It wasn't like completely off. It was, they had earnings.
Yeah.
But then.
So it was a real company making money, but it turned into like a value trap, essentially.
Value trap.
Classic value trap.
What does that mean for anybody that doesn't know?
Value trap is when a stock looks like, based on its most recent financials, that it's cheap, right? That there may be a bargain in this stock, but the trap in a value trap is that the numbers going forward into the future are going to be a lot worse than you think.
Yeah.
So most people will look at a value trap and say, oh, it trades at 7 times earnings. It looks cheap. It trades at half the PE of the market. And a lot of times what happens at the value trap is it's a stock that's like a melting ice cube, and maybe that melting ice cube is just starting to melt. And so it looks like, oh, they'll be able to keep this, decline relatively muted, or maybe they'll be able to grow again in a year or two. But the problem with the value trap is that then that decline starts to happen in the actual fundamentals, and it turns out to not actually be cheap.
Gotcha.
It all fell apart.
Yep. And then it just unravels and it turns into a death spiral.
Yeah.
Cool.
Yeah.
So cut your losses. Don't let day trades turn into bags.
I feel like that's kind of common in crypto, is like there'll be some altcoin that or some shit coin that just pops off, and then somebody's like, oh, I got to chase this 100% move, and then it like fades and it does like the long kiss of death.
Yep.
And then they're like looking at their their blockfolio or whatever, going, oh my god, man.
Yeah. And that's a classic psychological mistake that investors make too, which is to, especially younger investors, is to say, oh, well, I'm just going to get, once I get back to break even, I'll sell it. And, and it's like, well, actually, especially if the position is relatively large, what you might consider doing is actually get out, reevaluate, maybe look at other investments that have an opportunity to grow your capital and get you back to that wealth level that you wanted,
or cut the loss, and then if the fundamental thesis is still intact if it goes lower, you can always get back in.
Yeah.
So I got really good after that at just making sure that I cutting these losses.
Yeah, that's great. I mean, that really, when you make a mistake in the market, you have two options. You can either V-bottom bounce and do like a 180 turnaround and go, that sucked, I'm never doing that again. Or you can become stubborn and make the same mistake over and over. And the problem is like if you make a mistake and you don't learn from it and reverse from it, all of a sudden it becomes ingrained as like a bad habit. And then it becomes harder and harder to break that bad habit. And then people wonder like, wow, why do I blow out my account? And it's for those reasons. They don't turn around and actually learn from their mistakes.
Exactly. And we all make mistakes. Like even professional hedge fund investors. And
I don't know, Trav, you never made a mistake in investing, did you?
Oh my God, I made some big mistakes.
Okay, well, let's move on to you then.
Yeah,
what's
your
your big mistake?
Well, I think I've had two positions go be complete losses.
Okay.
One of them was a little bit more complex. It was a bond, distressed bond in an oil and gas company that went to zero.
Was this at the hedge fund or in your own account?
It was at the hedge fund, but luckily I had done this trade in my PA, my personal account, and we didn't invest in it at the fund because it was a much riskier play.
Oh,
and
gotcha.
I decided I thought I was going to take that risk in my PA, but that position did go to zero. It's kind of actually fascinating. I won't go too in depth, but this is a company that had like billions of dollars worth of oil and gas assets in the Gulf of Mexico. And even the lenders on the first lien loan, like the banks that had lent them money, didn't get all their capital back in the restructuring. Wow. So like everybody, not the equity holders, the senior bond holders, all that went to zero. And even the bank loans, which were only about $600 million, didn't even get 100 cents on the dollar. So that company, the value realization, even through the restructuring, ended up being like, in terms of a percentage of their assets, very, very low. It was like shocking how much value destruction there was.
So is this a mistake or was this just something that happened that you're like, okay?
It was definitely a mistake on my part, but there were also some things that happened that, were hard to foresee, which is that the value of the assets were overstated. Of course, oil prices continued to decline through that bankruptcy. So I had bought the bonds for 20 cents on the dollar, thinking they might be worth 60 to 80 cents or more, but that never played out. So that was one of the things. But actually, the one that was probably a bigger mistake, and by the way, I should say that position sizing is what helps keep you in the game.
Yes.
Like if you're going to have a total loss on something, which is bad enough in terms of making a mistake, if you're sizing your positions wrong, it can take you out and kill you. Right?
Yeah. Like if you take 100% of your risk capital and put it into one position and that goes bust, you're out of the game, period.
We spend a lot of time thinking about position sizing. I've spent years of research on position sizing. We talk about Kelly sometimes.
The Kelly formula.
Yeah, Kelly formula. I've spent a lot of deep work. I've actually developed some extensions of the Kelly formula that I've never even seen in print. Anyway, I spent a lot of time thinking about position sizing. So that helps save you even in these losses. But the other one that I had, which is a stock that I was going to mention, was HMNY, which I know
Movie Pass.
Movie Pass,
which I just saw. They're done.
Oh yeah, they're done.
They closed.
They closed doors. So what makes MoviePass so interesting is how fast this went to zero. Like normally I would reassess my thesis and I can get out of a position when it's only gone against me like 20% and I realize, okay, I made a mistake. But MoviePass, the situation happened so fast and the dilution happened so fast, the death spiral happened so fast that I didn't really have time. So luckily it was a very, very small position. But what we saw in MoviePass was that this was a company that gained a lot of user traction really quickly. I think it was 2017 or 2018.
Yeah.
They went from like 0 users to like over 5 million users in like the space of 6 months.
Because they were offering unlimited movies for like $10 a month or something.
Yeah.
So it was kind of a no-brainer offer, but it wasn't sustainable because were they like losing money on each customer?
Yeah. So like imagine going to the movie theater. Typically, one ticket would cost you $10 or $12, but they were giving you like the ability to watch unlimited amounts of movies for $10 a month. And the way that, so one thing that interested me about it was that they had obviously signed up a lot of users really quickly. Part of that was because the value proposition was almost too good, right? And so they were losing money because they were having to pay theaters for all these tickets that people were buying, and they were only getting $10 in return. But what I thought would happen was that they would end up partnering with studios, and they would find other ways to monetize the user base. They also had one of the former Netflix co-founders as one of the executives. So there were these signs that like this, you know, even though the business model is burning lots of cash up front, there were signs to me that maybe there's something here. If they build a big enough user base quick enough, they may be able to find other ways to monetize. And even though the financials look wonky, they'll take this big user base and they'll be able to monetize it.
Gotcha. So this was kind of like a low probability, high reward. Like it's probably going to fail, but if it does work, like the prices are so depressed that like the upside reward is really, really great.
Yeah, exactly. Yeah.
And we actually talk about this in the community a lot, is we call these like when we're talking about sizing, these are speculative types of plays, right?
Yeah.
Things like Icon, which had high debt, but they had, you know, they were still earning and all these other things. They had all these assets. Something like Movie Pass, they are losing money, but they have the potential to gain users significantly. These are even something like Neo, which is like the Tesla of China right now.
Yeah.
These are like more speculative in our speculative bucket. At least, am I saying
So
that right
is
for
it
you
kind of
too?
like venture level debt where it's like the probabilities of complete loss are high, but in the event that it does work, it's going to be a 10 bagger or more?
Exactly.
Yeah.
Even Overstock, people trying to play that for the blockchain aspect of it.
Yeah.
I was telling people like, okay, if you're looking at this is in a speculative bucket for me personally, like consider the risk that is on for this. And sure enough, I think Overstock's stock is like, you could pull it up, but it's declining. People are losing money on this stock. So knowing what you're getting into, being able to evaluate the risk level of it to determine your position size so that you don't blow up is key.
Yeah.
So yes, we've had these crappy positions that we look back and say, what the hell were we thinking? But they were sized right.
Yeah. So it didn't take, first and foremost, you got to learn how to survive before you can thrive, right? Yeah. And that means not doing anything that's going to completely take you out of the game.
Yeah.
So like for Movie Pass, like what size of your portfolio was that?
I think it was tiny. I think it was like a 1 or 2% position.
Okay.
And yeah, and luckily, you know, I often do start with a smaller starter position like that too. And so, and for a riskier company like that, like say Movie Pass or a biotech or something that has a lot of debt, it's always going to be relatively small. But some positions I'll go as large as 10 or 20% in my portfolio.
Of your overall capital.
Yeah, if it's compelling enough. But
gotcha.
But yeah, there's formulas for position sizing that I really focus on, and that helps me determine what you know, what the position size should be. And most of my positions aren't like Movie Pass. They're not. I'm not buying lottery tickets that are either zeros or multi-baggers. But you know, they're good companies at good prices that have long runways for growth. But occasionally, it's you know, it can be useful to have those type of positions. I mean, you know, think about some of the like, you know, 50 and 100 bagger stocks over the last 10 or 20 years. A lot of them, you know, started out as you know, kind of ugly looking companies or, you know, low price, low market cap companies that ended up hitting a stride and catching on and ended up being huge winners. Yeah,
absolutely. Okay, cool. So those are y'all's worst investments, complete blow ups and companies that go bankrupt. I'm going to mention for me something a little different. I can't really think of any single large loss that was like, oh man, that just hurt. I mean, like I always lose money in real estate. Anytime I try to do a deal there, I just fucking lose money all the time.
Maybe that's your worst investment.
One that I want to mention. Yeah, well, one, you know, so obviously those sting, but something that I think not a lot of people appreciate is like the opportunity cost of time. So like, let's talk about day trading a little bit and just like some experiences that I've had with that. So like, you know, back during the 2008 financial crisis, like day trading was amazing because you had like unprecedented volatility. You had all this like just insane daily moves that were just like shooting fish in a barrel. But like the years after that, like coming into like 2012 and 13 and beyond, it was like the markets got really, really contracted as far as volatility goes. And then tight range. And then like high frequency algorithms came in and they made it just really, really challenging. And so something for me was more of like along the lines of like death by 1,000 cuts, where instead of like pulling back and being like, okay, these aren't the best day trading conditions, I had some years where I was like, no, I was stubborn and I was just trying to trade like choppy ranges. And so even though my risk size per trade was very small, it was just grinding. It was like death by 1,000 cuts. I'm like, my drawdowns are big, not because I'm taking massive risk, but I'm just over trading chop. And had I, looking back, I did make the jump where I was like, okay, screw day trading. I'm able to make a lot more money swing trading and position trading crypto. And the futures markets are just overly competitive and it's a dry market right now, right? So eventually I came to that. But had I done that earlier, say like 2011, and gone in when I first heard of crypto, I'd be worth, woulda, coulda, shoulda, right? I'd have hundreds of millions of more dollars, right? And it's easy to look back and say like I would have and should have done that. But one thing that I would just encourage people, and like if I could teach anything through my lesson, is like if something's not working in the markets, know when to cut it off. Like persistence in the markets isn't always the best thing. Like in business, it's like, you got to work hard and got to persevere. In the markets, it's like if you can't prove that something is working in today's market conditions, then like stop and like look for something else that does have an edge. And like we always talk about this, like evolving as traders and investors, right? What worked last year may or may not work this year. And you constantly have to be on that bleeding edge of just innovating and thinking and, looking where the opportunity is.
And also finding what works for you, your personality and your style. Like maybe somebody day trading is too much for them. It gives them anxiety. They're trying to do it and they're stressing themselves out, but that maybe they need to be more of a swing strategy where they're not looking at it so much. And, then mentally they're not thinking about it as much. Yeah. So I also think there is something to having a trading or investing strategy that fits your personality.
Absolutely. Oh yeah.
Definitely.
Yeah, I mean, when I was in my 20s, it was real easy to sit in front of a computer for 16 hours a day and just basically be bleeding out of my eyeballs looking at screens. Nowadays, I'm
did
like,
the same thing.
Nope, not interested. Yeah. Okay, cool. So hopefully you guys got some value from some of those losses. Next question, Matthew A. asked, you guys talk a lot about investing in international markets. I know one of our last episodes we talked about international ETFs and stuff. How much does culture and governments play into those kinds of decisions? Some have pointed out that certain climates are more productive than others. Even religion could play a role. Okay, so I guess, talking or thinking about investing internationally, how do you guys look at culture and governments and religion, and where if at all, does that come into play?
I mean, I think that it's something to consider for sure, like the political side of things, right?
Because maybe like the rule of law or...
Yeah, like a government can come in and make something illegal or ban something, or, there could be...
Like China banning short selling recently?
I mean, so many different things could happen politically that could change the trajectory of an economy, right?
Yep.
So I say that's super important.
Yeah, there's some great examples here. The hedge fund, especially, there were certain markets we shied away from, Russia being one of them, because things can happen from a rule of law perspective. Like you said, strange things happen in Russia. Assets get seized in weird ways. There was a famous hedge fund manager who ran a Russian hedge fund in the 90s. I think his name was Bill Browder. I may have to go back and correct that, but I think that's the name if I recall. He's actually worried about being like murdered right now, like when he goes to Davos and stuff, because he made a bunch of really interesting deals in Russia, like post the collapse of the like communist regime there, and you could pick up like all these interesting like utility assets and various like businesses that used to be government owned for like pennies on the dollar, and if you did that in like 92, 93, And then like, 10 years later, you were looking at like 10, 20, 50, 100 baggers on some of those businesses.
Wow.
And Browder was one of the only Americans who had gone into that region and did something like that. But then later on, Browder had to flee the country because the Russians were like, oh no, they basically made up a bunch of stuff that he didn't do, at least according to him. And
Just trying to steal the companies back.
And they were trying to steal the assets back and, in some cases endangering his life, So you have to be careful in certain places like that. Especially if you're doing like, insider private equity style deals. If you're buying, public Russian stocks, maybe it's less of a concern, but I still have trouble with Russia. And that's why a lot of those stocks trade for like 5-6 times price to earnings ratios. You just never know what could happen with your ownership stake in a country like that, where you have dictatorship almost,
Yeah. And, I'm really conflicted about China because, I know China is growing quickly and, it seems like there's a lot of opportunity to invest there. You got guys like Ray Dalio that are really pro investing in China. And then on one hand, you got the CCP, right? Which like, I don't want to get too political, but like if you look at what they're doing in Hong Kong and you look at a lot of the human rights abuses with the Uyghurs and, like all the social credit system and all that dystopian, really scary shit. It's like, what do you do? And like also with the rule of law, like it's very, very questionable over there. So do you go in or how early is too early? Do you try to have political influence or, do you just stay out of that and say, I'm going to avoid any sketchy areas? Do you have an opinion on China or something like that?
China, like you said, you kind of hit the nail on the head. It's a very difficult one because it is such a large economy with such like great growth prospects in certain industries and certain companies. So I do own a few Chinese stocks that trade publicly in the U.S. One of the weird things, though, beyond the the political situation there, is the corporate governance. The Chinese stocks that trade in the U.S. are actually use this weird. The Chinese actually don't allow Americans to directly own Chinese companies. What happens is the Chinese companies that have gone public in the U.S. have essentially a Bermuda subsidiary or a Grand Cayman subsidiary that has a contract with the Chinese company to like essentially own a lot of the economics of that company, but then the U.S. investors own part of the Cayman company. So it's like this weird pass-through entity. There's a lot of like details involved with that, but essentially U.S. investors in Chinese companies, and this includes like Alibaba, Baidu, Tencent, some of the largest, Chinese companies out there. We don't actually own directly the stakes in those Chinese companies.
That's interesting. I didn't know that. So like Baidu on the NASDAQ, BIDU, which I think you have a position in, right?
Baidu's a big position for me, yeah. And I do think with the larger ones, and especially now that there are ETFs that hold like, I think in aggregate, something like $1 trillion worth of American money is invested in Chinese companies through these structures. I think now maybe it's gotten too big to be able for the Chinese to just like steal that from us. But there is like this small percentage chance out there that if the U.S. and China really got into it and couldn't, diplomatically resolve things, that maybe they pull that rug out from under U.S. investors.
Interesting.
So there is that small chance out there that is always sort of the back of my mind when I'm investing in Chinese companies, and that's why I don't let my portfolio get too invested in Chinese companies as a percentage of my portfolio.
Gotcha. Interesting stuff. Yeah. I mean, we are in such a globally connected world now. It is a lot easier to invest internationally, but there are those like really important things to consider.
Yeah.
Okay, let's see. Oh, did you have something else?
Well, I just to make that point too, is like, and there are countries on the other side of that, right? It's really easy and transparent to invest, for instance, in Australian companies or, UK companies and things like that. So, there are other countries where it's not as much of a problem. It's just we pointed out the ones that are.
Yeah.
Diversify.
Yeah. So do your diligence. Do your try to understand what you are really investing in if you're investing internationally.
Nice. All right. Harry asks, there's so much FUD and FOMO diverging in the crypto markets. How do you determine what market conditions create a buy signal? Yeah. So this is actually a really interesting question because any day that you wake up in the crypto markets, there's some kind of drama popping off. Yeah. Like,
why are y'all so emotional?
Just kidding. I love it. I think it's so entertaining. I enjoy waking up every day and like going to work and looking at what's happening in the crypto space. And there's so much development. There's so much good, so much bad. And it's a hodgepodge, right?
Never dull, right?
Yeah.
Never dull moment. Never a dull moment. Even if the price is
a lot of entertaining memes too. And
yes.
tweets.
I love it. So, okay, so here's how I'm going to answer this. So basically the question is with so much good news and bad news and fear and fear of missing out and also like fear of a collapse or hacks or whatever, how do you know when to buy, right? For me, it's all about looking at the chart because a price chart is truth. There's no bullshit. There's no opinion in the price chart. A price chart is a visual representation of the actions that were taken by all market participants, executed trades, right? That is like pure truth. So like a lot of times you can see the fear, you can see the FOMO in the price action. And for example, like there was something that happened. Let's jump over to Bitcoin's chart. It was early 2019. We had, let's go to a daily. So early 2019, once we started to break out of this range, so we were accumulating back in like the 4K and then 3K range. And then I actually bought this breakout on this day. This was just a very, very clear multi-month breakout above 4K, got above the both, moving averages. But what happened was, it was really interesting. After that, there was, over this next month where price was kind of chopping around 5K, there was like some negative news that came out. I think there was like a Binance hack and there was some other stuff that came out. And one thing I noticed is on these negative news days, they gave some red action. So like there was a pullback in price, but I noticed price was actually holding higher lows. So it wasn't like this was completely collapsing. It was like the fear was getting bought up. Mm-hmm. And you could see that in the price chart. Yep. Whereas if all you were doing was listening to opinions on the news or reading articles and, by the way, I think people should completely ignore any article talking about Bitcoin's price. Like if you have to read even like a CoinDesk, which is one of the better news outlets for crypto stuff, even the articles they write about the price, I'm like, you don't need this article. Like this is somebody's opinion about the price. Look at the damn chart and make your own decisions based on what you see there. Yeah. But anyway, like when you see something like that where there's fear coming in and there's all this negativity and you look at the price action, you go, well, the price action is actually telling me a different story here. So for me, it's being able to look through the FUD, look through the FOMO, and say, well, what is actually happening? And you can see that in the price action a lot of times.
Oh, yeah. And if you go back to that chart, one thing I remember about that consolidation zone from, I think it was 3,500 to 4,000, that 4,000 breakout level, I remember seeing people tweet and get super, super frustrated and they missed it on that breakout of 4,000, that big breakout candle. Yep. And they were like, I can't believe it. Da, da, da. And I'm thinking to myself, I didn't say this to anybody, but I was thinking to myself, okay, that consolidation for what time frame was that? I think it was months, right? Like
it basically was for about a whole month.
No, before the breakout.
Oh, before the breakout. Yeah. So it was basically November 18 through April.
You had
several months.
Higher lows forming.
Yep.
Clear resistance around 4,000 or resistance around 4,000. There were so many things in the price action screaming we might see a breakout. Yeah. And for people to be shocked and taken by surprise and all of these things, I was like, okay, maybe more people need to learn how to really, truly read price action well. Yeah. Because it said a lot to me.
It absolutely did. And like, not, another shameless promotion of my amazing meme that I created here. Bitcoin at 3K. This is what people look like for you guys listening on the podcast. It's a, the lady with her head in her hand, so sad, but and then Bitcoin at 10K, people are lighting money on fire, smoking cigars, partying, right? Like people have such a reaction.
Opposite.
Yeah. It's so weird. And this is what I said too. I said, our DNA is programmed to make us sad when prices are low, aka cheap, right?
And you should be happy for a deal.
Yeah. And we get euphoric when prices are expensive, right? But that's why, most people lose money is they do the opposite of what you're actually supposed to do in the markets. And this is just case in point back here.
Yeah.
Yeah, well, I do and it's interesting because there is some truth to the psychological bias, right? Like HMNY, Icon, our biggest losses that we talked about. Yeah, like it made sense to be sad when we were down 80-90%, you know, because like we weren't going to recover that.
Yeah.
But when you have an asset where, you know, the price isn't really reflecting its true value, then when it's down, you should be like, oh my God, I'm so excited about this.
Yeah.
You know, that's how I feel now when I find a stock that I've done a lot of work on and I'm very confident in the underlying value and it just keeps selling off and I'm making my position bigger.
You just get like,
and
yes.
People are wondering,
man, I feel so awesome about it. Yeah.
And people are like, how low are you going to let it go? And Travis is over here like, this is, you know, like licking his chops. Like people have to understand that when you're looking at something for valuation and you see that, you see it selling off and you're getting a deal, it's exciting.
Yeah.
It's like if the market right now, if the S&P 500 dumped 50% right now, we would probably be freaking high-fiving and like excited, you know?
Yeah.
So I don't know.
And we did say earlier, you know, sometimes cutting your losses is the right thing to do, right? And not bag holding.
Yeah.
But what we're saying here is something a little different. And the distinction is this. If you've done the work and your thesis is intact, then buying lower actually is a great thing. Now, if the price is going lower and the actual fundamentals have changed as well, and your thesis is not intact, then cutting your losses absolutely makes sense.
Yeah. And in trading and investing, there's all these like cliche truisms, right? Where like, you know, you could say like never add to a losing position. Well, that makes sense, right? In theory, like if you have something that's losing, you don't want to average down against it. Yeah. But like, how do you define losing, right? Like in your case, it's like, no, my thesis is intact. My reasons for this investment are intact. Mm-hmm. I'm just getting cheaper prices versus I'm bag holding Icon and it's dying.
I know it's dying.
And like, well, I can't accept that. So I'm just going to buy lower to get my cost basis lower.
That's different.
That is completely different, right?
Yeah. That's the difference between like hoping and, you know, knowing. It's
yeah, cool. Okay, so next question, Rakesh asks, what would be an example portfolio for a 30-something-year-old looking to build a new balanced portfolio in 2020? So this is kind of a loaded question, right? And I know it's like hard to answer this without having a lot more information, but like maybe we can answer this at a 30,000 foot overview. Say you have someone who's relatively young who is looking to build a new portfolio. So they don't have a low cost basis in equities or let's assume even crypto. Let's say somebody who's not invested at all, Nikki, putting on your certified financial planner hat, where would you direct somebody like this to start thinking about
so
it?
the first thing I would say is there's, you know, obviously the younger you are, the more equities in your portfolio you can have. Obviously, it all depends on your risk. I don't know what his risk tolerance is. It could be conservative. It could be aggressive. So you could, for something that's balanced, you're looking at like a 60-40, like a 60 bonds or a 60 equity, 40 bonds, or maybe a 50-50.
Yeah.
50 equities, 50 bonds. I'm talking in percentages here.
Yeah.
that'd be for like an average.
That's very
just
like,
your very
risk
simple.
And for a 30-year-old, that's a conservative, like a 50-50. For a 30-year-old, that could be considered conservative.
Yeah. Like 90. Like 90% stocks for me.
So but a good
and why is that considered riskier or more aggressive to have more equities than bonds?
Well, equities are riskier assets. And bonds don't have bonds have less volatility. Equities have more volatility. So the idea is when you're trying to do something balanced, you want the bonds to kind of help. If we do see a big correction in the market, you want the bonds to kind of help level things out or make it not so bumpy of a ride, right? But for someone that's some 30-year-olds might be like YOLO 100% stocks.
Yeah, or YOLO 100% shitcoins.
Or that. So that's why I say something balanced is going to have some element of either commodities or bonds or maybe Bitcoin.
Yeah.
Maybe like you're getting yourself diversified through different asset classes.
Yeah.
Maybe some REITs for real estate exposure, getting some dividends.
So basically the main asset classes for a balanced portfolio, like passive portfolio is what I'm assuming we're talking about here. Stocks, you know, AKA equities, bonds, could be government, could be corporate, alternatives, right? Crypto, real estate, metals, commodities, and then some kind of soup of that,
Yeah,
right?
because you can break it down even further. Equities, okay, domestic, international, emerging.
Yeah.
You know, same thing with bonds. Okay, corporate, government, you know, muni bonds. Like, what are we talking about here? So
Yeah.
you can spread it out across many different categories. But a good rule of thumb for anybody that isn't sure about how much they need in equities versus bonds and other classes is they say you take 100 and you subtract your age from 100 to give you how much you should have in equities.
Gotcha.
So someone that's 30 would need, according to that very general rule,
Yeah.
would say, okay, 70% equities is okay for me.
Yeah.
So you kind of, I tell people, okay, that's general rule. Okay, how does having 70% equities make you feel?
Right.
How do you, maybe it stresses you out and you want more bonds to be a little more balanced.
Well, and I've seen several studies. I don't know how peer-reviewed or academic these are, but talking about how millennials are way more interested in crypto than equities. And I can understand why. And like, as somebody who is a big proponent of Bitcoin and crypto and has been in this space for a long time now, like I get it, but I also don't want people that are in the crypto space to underappreciate stocks, right? And like, I get it. Like, after the 2008 financial crisis, like, our generation was like, screw Wall Street, man. We don't trust these guys. Like, what is this? But like, I think that's why it's good to bring you guys on the show to talk about what stocks really are and like why they have been the best performing asset class in the history of humanity over the past 100 years, right? Obviously, with Bitcoin's short 10-year history, like, that's been extremely profitable and extremely fast growth, but like,
But higher risk.
Higher risk, obviously, especially with the volatility.
Yeah.
And something could happen where Bitcoin could fail, right? Like, that is a low probability, but it is something that could happen. Trev, why don't you just talk about, like, briefly, like, why even own equities to begin with?
Yeah. Well, equities are what underlie the economy. It's what, what provides people jobs. I mean, equities are just ownership stakes in businesses. And so when you look at, the collection of businesses in a country, like, that's who employs people, that's who, helps drive the economy. So, equities are just the ownership of these companies. And so, there was a huge drawdown in 2008. The market was down, 40% in like less than a year. But here we sit, 2020, and the market's up 300 or 400% since then. So, over time, over a long period of time, despite this volatility that we see, we expect the value of the economy, the value of the businesses in the economy to grow. And so therefore, we expect the value of stocks on average to grow.
Yeah.
Now, that doesn't mean that every single stock or every single business is going to grow in value. There are some that lose and there are some that gain massively. But, overall, when you look at an index like the S&P 500, it owns 500 of the largest companies in the U.S. It has averaged about 8%, average annual return over like, many, many decades. And when we look at that versus other asset classes, it tends to be one, if not the highest performing over a long period of time.
Yeah.
And again, we don't have that much data for crypto, so we don't include crypto in that, that look yet. But when you compare it to bonds and real estate and commodities and things like that, equities really do perform, at least historically, very, very well.
Yeah. And the way that I look at it is, are you bullish on humanity? Like, are you bullish that we're going to keep creating products and services? We're going to keep innovating. Like, I'm more optimistic about the future of humanity than ever before. Like, look at the amount of information and the amount of access to resources and knowledge we have. Like, it's unprecedented, man. I love it.
One quick thing on this question, though, by the way, is that, I think part of this question may be hinting at, like, how do you build the portfolio, not only like the allocation, but also like, do you buy it all now? Do you wait in? Like, do you focus on, ETFs, or do you pick single stocks? There's a lot of like questions that underlie this broad question.
Yeah, we could talk for 10 hours just about this one question.
It's a tough one.
And that's essentially what financial planners do, right? A CFP like Nikki will sit down with you and actually talk to you and say, okay, well, like, how much income do you expect? What's your risk tolerance? Like, and stuff like that, and consider where the market is right now. Generally for a 30-year-old, like, you have a long investing time horizon, hopefully, so you can put a lot of money, most of your current capital to work, and not have to worry about short-term drawdowns. So that's one nice thing.
Yep.
But yeah, there's just a lot we'd need to know to get like really specific about, okay, more stocks, less stocks, more active, less active.
A lot of levers to pull.
Yeah, a lot of levers to pull, exactly.
Yeah, it's tough.
Awesome. All right. We got a couple more questions and then we'll wrap it up. So David asked, my wife and I are in the UK. We're moving to Malta. We're looking at investing in Bitcoin and would like to know, is it a good time to invest now? And who do we invest with, as there are a lot of scams? This is a question I actually get every single day of my life, is like, should I buy Bitcoin? If so, when?
And where?
And where? And I'm like, okay, so I've answered this so many times, I can do it very quickly and efficiently. Step one, I'm not your financial advisor, so I'm not going to tell you like go buy right now. Yeah. Step two, and this is just kind of a general statement that I feel really comfortable making, is like, I'm bullish on Bitcoin over the long term, right? I don't think it's going anywhere. Obviously, anything could happen. I'm bullish over time. Bitcoin is extremely volatile. So with that said, I think it makes sense to, if you're going to buy Bitcoin, buy an amount that if it went down by 90%, you would not freak out and sell it, and you would still be able to maintain your quality of life.
Yes.
That's the first step.
So much, yes.
Yeah. But maybe have enough skin in the game that if it goes to 100,000, you're not going to be kicking yourself saying, "Oh, I should have bought more." Right? It's like a balancing act between not buying enough and buying too much.
That goes right back to position sizing, like we talked about.
Yep.
Absolutely.
Yeah.
And there's actually an argument right now amongst financial advisors if it's irresponsible to not have some Bitcoin in a portfolio.
Absolutely.
That's like the big argument right now.
Yeah.
Well, we've talked about that too in the context of like the negative correlations to stocks and things like that. These other properties besides just the absolute return that, as part of a portfolio, make it potentially even more interesting.
Yeah. Yeah. There's so many benefits to it. So I'm bullish. I think everybody should own some Bitcoin. I'm not going to tell somebody how much to buy, but think about that. Like, what's an amount that if I buy and it goes down by 90%, I'm going to be okay and I'm not going to freak out and sell the bottom. Yeah, there you go. Oh, and as far as like where to buy, go to the major exchanges to start, go to Coinbase, Kraken, so do this. Go to
Malta's in the Euro area, right? So that would be, you should be able to, I think, have a Kraken account or something like that.
Oh yeah. I mean, so if you go to the exchanges, and just look at where the biggest volume is coming in, Binance, Coinbase, Bitfinex, Bitstamp, Kraken, like look at all of these, and stay away from Chinese exchanges. That's really it. Go where the most liquidity is being traded and explore those as options. All right. Last question. Zlatan, I think, if we're pronouncing that right. Hey, Chris, it'd be great if you could spend some time on the show talking about learning platforms and tools that can help beginners or intermediate investors to learn about stocks and crypto and fundamental analysis. So I'll let you guys take this. Any learning platforms?
Yeah, it's a broad question.
Yeah,
Nick,
so obviously there's some of the free stuff that's out there, meaning free resources. I like Seeking Alpha to kind of get some sentiment and read through different articles that other authors have written. Sometimes that can get a little
biased,
or a little
authors.
Incorrect, but it's kind of a good place to just start, like reading about how people think about fundamentals and getting the terms in there, right? So, and then, I don't know that term. And then you go Google it and search it and you can learn as you're reading.
Yep.
That's kind of one of the things that I tell people. But as far as other learning platforms and tools, like Travis and I both have courses that we literally made for this exact purpose.
Yeah.
That's right.
So
So shameless plug, on skillincubator.com, we have our wealth building community, and in there you guys do weekly classes. We do weekly crypto classes, and obviously a lot of people like to see our alerts, but like on the learning side, I think it's just really nice to be a part of a community where you can hear people's thought processes about certain things, like deep dives. Like I know you like to do deep dives, Travis, on different companies.
Yep, I do deep dives on different companies, different topics occasionally. I've got about a 5 to 6 hour course for beginners that walks through a lot of, from the very highest level of like, stock performance over time and why should we own stocks and what are stocks, to very detailed things like what is a PE ratio, what does it mean, how do you interpret it? Yep. So yeah, I've got that course. I'm doing some more live boot camp courses later this year. to really help people with, practical aspects of researching stocks and things like that. So yeah, that's really like, I get asked this question a lot, which is like from my friends is like, hey, where do I go learn about investing in stocks? I don't know that much. And there's not like a perfect resource out there. So I'm trying to build a lot of that into my courses. There are sites like you can just go Google terms when you read them and you don't know them, like Investopedia.
Investopedia is great.
Corporate Finance Institute. There's a few books that I think are useful. We talked about before on the stock side, like One Up on Wall Street or something like that is a pretty good one to start with. On the crypto side, I'm not as familiar with what the best beginner resources would be.
I think the best way to get into crypto is just to get into crypto, like meaning like just start doing stuff, like buy some Bitcoin, get some hardware wallets, play with some exchanges. And then if you're going to look at altcoins, most of them are scams. Let's start with that. Like most of the 2,000 plus altcoins that are listed on CoinMarketCap or wherever are going to fail. Like that's just the nature of this. Like that's what's going to happen. So you want to be really picky and choosy. And like after the 2017 ICO bubble, like we saw the result of a gold rush, right? We saw all the scams that come out. And so just be really careful on the crypto side. But when it comes to fundamental analysis, like it's as easy as going to the project's website, going to their Telegram group, reading white papers, like make sure you understand it and don't accept anything as truth until you really, really dig deep. Like if you read a white paper and you're like, oh, this is great, they're going to change the world, okay, great. That's a starting point. Now look at, who are the founders? What's the funding scheme set up like? What are the economics of the tokens? Is it a pre-mine scam or is it, fair launch? Like there's so many things to think about, but like just start and be skeptical about everything.
Yeah.
That's probably the best way to start.
And there are some good guides. Like I know there's a few on GitHub that are highly starred or rated around Bitcoin and crypto. There are a couple books like your book, Safadin's book on the crypto side, right? So real deep dive stuff you can go out and read on that front. Yeah.
So I think that's it. Just dig in. Like there's no replacement for experience. We obviously have a community and we provide education and training, and we like to keep just a really tight core group of people that are really serious and not just looking to get rich quick. And then aside from that, like just go and research everything, man. Be skeptical and
Google everything.
Yeah, it's a journey. It takes a long time, especially on the fundamental analysis side. If you're looking at like fundamental analysis of stocks, particularly, you could get real deep into corporate finance, accounting, valuation theory, and things like that. So it took me several years of undergrad as well as multiple years after really working in the industry to feel like I had kind of gotten to a mastery level. But you can get up that learning curve pretty quick. Like if you can, in a year, if you spend enough time devoted to it, I think you can get to at least like an intermediate level where you at least understand the basic terms and most of the basic stuff being talked about.
Yeah, absolutely. All right. Well, guys, thank you so much for watching or listening to this episode of We Talk Money. Hopefully you got a lot of value out of it. Just a couple of things. Go to wetalkmoney.com to submit any questions that you have for us. Also, don't forget to subscribe through iTunes or Spotify or wherever your favorite podcast app is. And
Happy Valentine's Day.
Happy Valentine's
Don't forget
Day.
your significant others.
All right. Take care, guys.
Take care.
Bye.